Hello, everybody, and welcome back. And a big thank you to David there. Moving on to our next topic, we have a discussion around lower power prices and merchant risk, the new normal, mainstreaming profitability. This will be led by Carlos de la Peña, who's a partner at McKinsey. Carlos will be joined by members from Hannon Armstrong, Encavis, and ABN Amro. So as before, there will be time for Q&A, so do get your questions in using the Q&A box just to the side of the video player, or log on and use the website URL Slido, slido.com, and use the acronym for Future of Renewables, FOR 2020. Without further ado, I'd like to hand over to Carlos. Carlos, take it away.
Thank you very much. So good afternoon, everyone. I think over the next hour, we will be covering three main things. We'll start with a short introduction of the participants to the panel. Then we'll have a discussion around certain themes that build on the topic for 45 minutes, and then we'll do Q&A at the end. So first, we'd like to start with a quick round of intros. So maybe Marc, you want to go first?
Happy to, thank you. Hannon Armstrong is a publicly traded investor in climate change solutions. Everything that we invest in is focused around addressing or otherwise mitigating climate change. My role within the company is that I lead our private sector investments, which is primarily focused around US renewables, wind and solar primarily.
Dierk, you want to follow?
Yeah, thank you, Carlos. Hello to everybody also from my side. Dierk Paskert, CEO of Encavis. Encavis is a strategic investor in renewables since more than 10 years. We have a buy and hold strategy. So we buy predominantly solar parks and wind parks and operate them over their asset lifetime. So we don't develop and we don't flip assets, but we buy into the assets at a certain stage of development. Most of that is late stage development. So far, predominantly our portfolio consists out of feed-in tariff parks, but now moving with bigger steps into the open merchant markets, PPA world, as we have just connected two of our biggest parks in Spain with 500 megawatts.
Yeah, thank you very much, Dierk. And last but not least, Lisa, you want to introduce yourself?
Yes, hello everyone. Lisa McDermott. I'm an executive director at ABN Amro Bank. For those of you not familiar with ABN Amro, it's a Dutch bank headquartered in Amsterdam, focused mainly on European activities. And I'm on the debt financing side. I lead the renewable energy and energy transition financing activities for the bank. So we finance a wide range of renewable technologies and also, as was just mentioned, a mix of different revenue structures, feed-in tariffs, but also merchant projects with PPAs.
Yeah, thank you very much, Lisa. So I think we now dive right into it, right? So Lisa, Marc, Dierk, I think that over the last, I would say, maybe 8 to 12 months, we've seen an acceleration of the energy transition with many kind of entities, governments, companies going for very aggressive decarbonization targets, right? And I think one of the biggest questions is whether we believe that the current pricing scheme and market mechanisms will actually support such a renewables deployment. So maybe that's the first question that I would like to discuss with you. Do you see that happening, or are there showstoppers that will avoid, that need to be handled in order for this transition to happen?
If I may flip it first, so it's I think for let's differentiate between those two markets. On the feed-in tariff sides, yes, I would say there's things are working out quite well. Yes, we have a lot of capital queuing up to invest in that part or segment of the market. That's definitely there's attracts a lot of capital. So I don't see any significant change there, other than that it becomes more and more competitive to buy into that segment. But I think it's it hasn't seen a big change. It's different for the merchant and the PPA part of the market, because now you have to deal with volatility. And for sure, the one question, I think, or the one answer is always right. Prices are harder to predict, and they will be volatile. And even if you have logged in a first PPA of 10 or 15 years, you will certainly have another 10 to 15 years, which are not covered, which are always merchant. And so therefore, that is a bigger challenge to the market. And I think market participants try to get their arms around that. That's the current status.
Yeah. And building on your point around the feed-in tariffs, do you see another support regimes like contract for difference? Do you see that the current mechanisms are, and let's talk, for example, about offshore wind in the UK versus other markets, like certain mechanisms kind of de-risk investments more or less. So to what extent do you see the need for that de-risking to happen in order for capital to get and flow into the renewables as planned?
To me, or
well, yeah, there was more to Lisa.
Yeah,
I think.
Yeah, I think maybe I could take that one. We're quite active in the offshore wind market, indeed. It's a very interesting question, because, of course, offshore wind's going to be, you asked about building out to all these targets, and that's not going to happen without offshore wind. So that's really a key technology to focus on. It's a very relevant question, of course. Living in the Netherlands alongside Germany, they're one of the two markets that really were in the lead in terms of subsidy-free offshore wind. So back in 2017, for both countries, they had their first subsidy-free offshore wind auction, and everyone was really cheering that this technology had achieved grid parity, and particularly the governments were very pleased with themselves. But certain pitfalls of that model are starting to emerge, and you can see, well, first of all, in Germany, they haven't had consistent subsidy-free auctions since the first one. That has been the case in the Netherlands. Actually, we've had 3. But if you look at the 2020 auction this year, there's only 2 parties that actually bid. So actually, the appetite for the subsidy-free model is quickly waning. And certain parties, including one of the main parties who won big in the first 2 auctions, is actually expressing concerns about the sustainability of this model, and have publicly said, we don't want to finance too much on this sort of model. So, I actually don't see it as being possible to achieve the build-outs based on a subsidy-free model, unless there is a sufficient appetite within the corporate PPA market. And at the moment, there just is not, to support the size of offshore wind parks we're seeing. So that's definitely a concern, and that's been evidenced through some lobbying that we've seen in both Germany and the Netherlands, and some public inquiries, let's say, or investigations about how the market thinks about this technology and this financing model. So there's plenty of capital, but that capital just does not have appetite to do fully merchant financing in most renewable technologies, and certainly not the billions of capital that's required for offshore wind. So I think, to answer your question, I think there's certain other models within Europe that are probably more promising, such as the UK, the two-way CFD, and Denmark's new two-way CFD, which I understand has a bit of upside profit sharing for the project. So it's a nice commercial model, but something that you could actually achieve a financing on. And maybe to say that we're talking a lot about merchant, but most jurisdictions within Europe do actually still offer tariffs to support renewables. There's only a number of exceptions, maybe what I mentioned in offshore wind, the Nordics, Spain, they're moving to more merchant model. But the fact that not everyone's moving that way suggests that there's some need for tariffs still, and probably for quite a while to come.
Yeah.
I think it very much depends also on the risk category you're looking at. And I mean, renewables sounds like one asset class, but it's not. When you have offshore, probably the most risky part of it, you have onshore wind, and you have solar. And all 3 come at different risk return levels into the market, and have, let's say, their peculiarities. So therefore, It is not one model we can look at, so it has to be dedicated to these three asset classes. The easiest probably is PV. It's the simplest technology, probably comes cheapest in terms of LCOE, but it can't make, let's say, all the energy production. So therefore, we have to look at a world where we couple, let's say, offshore, onshore, and solar in order to achieve our CO2 targets. So therefore, just looking at PV because it's simple is not the solution, at least not for, let's say, climate change.
I think the comment you made about risk, I think, can very well be applied to the contract structure as well, in addition to the asset class. Something that we've seen, a fairly significant shift we've seen in the US at least, is for contracts to become much shorter and much more buyer friendly of late. And the sponsor and investor community have largely absorbed that risk and continue to make those deployments very attractive. But I think that's a very important shift that's occurred. And so when we talk about whether the contracting structure can support continued deployment, there's many more factors than just the contract structure, because many long-term investors, the only way to make that investment is to absorb some material amount of merchant or exposure. And so there's a much greater focus on the dynamics of the power markets and the valuations that are applied to merchant, as opposed to just the contract structure, which certainly we would have seen 5 to 7 years ago, investments almost exclusively made based on contract structure.
Yeah, and I guess going back to this point of merchant versus regulated or supported renewables deployment, I guess if you had asked many people like 1 year ago, probably they would have been much more bullish on the merchant side, with technology costs going down, some big markets on PPAs ramping up. Lisa, you mentioned Spain, Italy, and many others as well. But COVID has changed probably the paradigm, not only in prices, but also in the willingness of governments to really drive this change. How do you see this impacting the outcome? And is this here to stay, or will merchant renewables come back in some years from now?
Yeah, I mean, they're probably already there. I mean, luckily I'm on the debt side, so supposedly the lowest risk. Obviously, Dierk on the equity side there is, and most equity investors already take significant exposure to merchant. The tariff period is used to pay off the debt with a bit of excess. In the olden days, quite a lot of excess for equity, but these days things getting a bit tighter. But if you go out into the full, asset life, then obviously the back end tends to be merchant anyway. So equity investors have always been more exposed to merchant. But I mean, the price forecasts I've seen show in most countries a recovery within 2 to 3 years, but it's not the case everywhere. I mean, I think the Nordics in particular has been hit quite hard by this. Yeah. I mean, they've had the perfect storm, of course, of full hydropower plants, so a warm winter, etc., etc. It's compounded the COVID problem, but the prices there were incredibly low. And the irony was that a lot of investors were moving to the Nordics when they couldn't get the yield from other jurisdictions where there were regulated tariffs. So actually, ironically, they moved there because of the high percentage of merchant revenues on deals up there, because there was no subsidy. Well, there hasn't been a subsidy for a long time, any significant subsidy. But the irony is that's kind of worked against them, and a lot of those projects are struggling. We've seen massive value erosion. There's also been a big rush for power hedging, something we haven't seen in that market for a long time. All the utilities trying to protect future revenues. And the forecasts, unfortunately, for the Nordics aren't looking like they'll bounce back in the short term, unlike the other markets. So I think that's one where we're probably seeing the most pain.
Yeah, I think I would fully agree. So prices have come down during the last 12 months significantly, so 30% and more. Some have come back to levels, let's say, if you look at contract terms of 10 years, you are not yet back to the, let's say, pre-corona times, but also not that far away. So if you look at the, let's say, 10-year horizon, it looks kind of okay. It's more, let's say, if you would have an open merchant exposure now, then let's say the day ahead curves and the short-term curves, they have come down significantly, and there's still a big gap. But for the longer term, I think it looks like it's slowly recovering. So therefore, I would expect at least as we need renewable power, and we should not forget that starting next year and increasingly more and more European countries, at least, we have the phase out of nuclear, of coal. I mean, the power has to come somewhere. So there is, this is a physical system which we have to hold up. And there can't be shortage of power because then we have blackouts. So therefore, I think with, let's say, the closure of conventional power plants and nuclear in Europe, above all in Germany, but also in neighboring countries, I think we will see a rise in power prices. But short term, yes, COVID, nobody had COVID on the agenda. And it has, let's say, surprised everybody this year, yeah, definitely. But I wouldn't expect that it holds too long. And the Nordics, that's true. But Nordics was always a special market because it all depends on precipitation in the reservoirs in the Nordics. So this was always a very special market and not connected or not 100% connected to the let's say, Central European market.
Yeah. I'd say our observations are fairly consistent. Absolutely a drop in the short term. The jury's still out in the long run. I think just one other related but slightly different point is that we've seen our clients, particularly on the distributed side, increase efficiencies due to some of the changes by effectively moving to a fully electronic platform. And so that's been a change that's been a long time coming, but accelerated, into the matter of a couple months due to COVID.
Maybe sorry, go ahead, Dierk.
No, I would fully support that view. So that if you, let's say 2-3 years ago, if you would have invested into these asset classes, you would expect to get a kind of stable return out of your investment without doing a lot during operations. Now it becomes much harder to get your margin, and you have to tap into more value pools. So operational excellence will become a major factor. It won't, let's say, rescue your investment. So because once you have spent your money, it's hard to get back and just through operational excellence. But operational excellence can make the difference. Yeah, so it can save you the 50, 100 basis points in your IRR expectations. So does it with, or there are other value pools you can tap in, so which is hedging power prices at the appropriate time, and so on and so forth. So it's more cumbersome to stabilize your margin and to get your margin, but it's still doable, I would say.
Yeah.
Yeah, maybe to add a few of the other sort of tactics that we're seeing at the moment is, well, I mean, developers, I think if you're already in a project, it's kind of, maybe tough luck if you haven't hedged properly. If it's far out, you might be okay. But we saw a few projects that were, right in the middle of COVID, and then the behavior that has resulted in. And for instance, developers were on the point of selling, and they find that the enterprise value of the project just dropped. So they're doing something they've never done. It's kind of hold projects post COD, which is interesting, and probably about 50% of them considering turning themselves into an IPP. Yeah, and then because obviously hedging, the corporate PPA prices that are able to be realized have been impacted by the future curves as well coming down. So that is not very attractive. And we're seeing, ironically, given the depreciation in the power price market, we're seeing a lot of sponsors trying to finance a higher percentage based on merchant cash flows, which, as I say, is counterintuitive, but it's the only way they can realize a yield. And the other thing, which is a bit more worrying for me, is this massive rush to secure baseload PPAs, corporate PPAs, even for highly intermittent wind projects. And that doesn't seem to really, go together with a wind project. But obviously, the price for a baseload PPA, you get that marginal price increase, and that's another sort of yield grab we're seeing at the moment.
Yeah, so it all goes to who holds the risk, right? And who's the better owner of the risk. Back to the capabilities that Dierk was mentioning. So maybe if we take just a look at the future, right, we see probably prices having more, a bit pressures to the downward side than to the upper side, right, with more renewables. I think Dierk, you mentioned a lot of plants with the merchant tail that will come off subsidy in some years from now and will have already sunk most of their investment. Will lower prices mean lower profitability for renewables, or will profitability be offset in some other ways through carbon pricing or subsidies? How do you think about that?
Yeah, I think you have to manage two sides of your P&L. The one is, let's say, your the top line, so the prices. Yes, it's something you have to be on top of things. So be really up to date with to handle merchant volumes in the market and hedge it at the appropriate time. So that will be a key capability needed with every investor in the future. It's doable. We have seen that for decades in the conventional energy market. So this is not rocket science, but you need new competencies, which most financial investors today do not have. So therefore, if they do not have today, they have to have it in future. And second is you have to, let's say, have a close look at your cost structure, so operational excellence and all the other things, trying to get additional margin out of, let's say, right timing of projects, stay prudent in your and conservative in your investment case. So don't, let's say, buy into a project if you have not secured the PPA, and so on and so forth. So there's many mechanisms you can take, and if you stay conservative and prudent in your behavior, I think then we still have the same outlook on return expectations as we had in the past. I would even say it's becoming even better because the market opens so many opportunities. We are complaining about a growing market. It's just managing it. So therefore, that is probably a little bit more cumbersome, as I said, as in the past, because it was in the past so easy. Now it's not that easy anymore, but it still opens numerous opportunities.
Yeah. Marc, maybe the US view there?
It's hard to, be somewhat bearish when power prices are continuing to go down. That being said, so is debt cost. So base rates have gone down, capital costs have gone down, and the long-term investor community continues to accept the shift to merchant risk as well. So I think so far the continued power price declines have been absorbed by the community. I think that one thought that comes to my mind, both in terms of when we're talking about the volatility of some of these markets and inputs into the viability of projects, along with talking about more complex power market strategies and more complex revenue contracts. I think that the capabilities of the developer and sponsor become a lot more important. not only in just managing the power market offtake, but also the ability to adapt to a more volatile market. So power prices might be going down, but so are base rates. That could change at some point, not too long from now. I won't guess. I don't have a crystal ball, but the important part will be to adapt during that development cycle to account for those changes. And again, I think that's driving more and more volume. Some of the larger players.
Yeah. Maybe one thing to mention is, I mean, looking at the demand side, I think that could be an important driver to keep prices at a decent level. There's a couple of really important policy developments that have happened in Europe, in particular over the last year. I mean, the first one, the EU, the Green Deal. It's quite European based, but that's going to be a massive decarbonisation policy exercise, which should obviously, lead to carbon pricing, influencing and preferring renewable energy, hopefully. And the second thing, of course, which is not just a European, let's say, subject, is hydrogen, which we haven't mentioned. But, green hydrogen, again, massive part of the EU Green Deal, and the EU has come out with its hydrogen strategy, as have a number of key European countries. Ambitions are, off the scale. And of course, green hydrogen requires huge amounts of renewable energy. So I think the electrolyzer market is going to potentially be a very important purchaser of renewable energy going forward. And whereas we've seen the true corporate PPA market, not being sufficient to sustain these volumes, that won't be the case for the electrolyzers once they scale up. So I think that could also help preserve pricing on the power, on the sort of offtake side, let's say.
I would fully agree. So that is a very important development on the technology side. So we all know that we need for intermittent energy production, which wind, solar is and will be forever. So we need storage. Batteries can do a little bit, but definitely not all. But hydrogen, green hydrogen, can do a lot, and so it just can make your power at different times of the day more valuable. And I think this will be a key driver in all strategies ahead of us. Green hydrogen is probably 5 years still away from really becoming a competitive technology, but it is on its way, definitely, and probably on the same path as we have seen with other technologies in PV and so on. So just take that role model, look 5 or a little bit more years ahead, and then we are there. So therefore, these kind of dynamic developments in the power markets have to be taken into consideration, and they can let's say, change the picture a lot, definitely.
Yeah, and maybe just to contrast that with the corporate PPA purchasers, I mean, it's pretty optional whether they buy green power or not. Some of them have got a range of agendas for doing so, whether it's price fixing or more the ESG agenda. Electrolyzers have not got a choice whether they buy green power or not. I mean, that's a basic underlying assumption for green hydrogen. So yeah, and obviously this hydrogen market will have to be heavily subsidized in order to commercialize it. And part of that in mind, obviously, will have to be used to buy in.
Oh,
I think Lisa lost.
Lisa lost. If I could add one other aspect, Carlos, which we have also not talked about, is yes, we will always have a kind of a volatile outlook ahead of us on a single asset basis. So you can't avoid that, as power markets are dynamic and will move, and they will move upwards and downwards. So we won't see stable power markets, so because power is the purest commodity you have on earth. And so therefore, there will always be a movement. However, therefore, don't look at just at the single investment. You have to look at from a portfolio perspective. And in a portfolio, you can handle this volatility, be it from a country perspective, so not all eggs in one basket, be it from a technology perspective and some other measures you can take. So from with a portfolio aspect and strategy, you can manage that volatility, and then you are doing fine. If you do it just on a single asset by asset basis, then it will become hard.
Yeah, and I guess we've talked a bit about integration capabilities, right? We've talked about being able to manage risk, and those trends are very clearly communicated so far. Maybe moving the conversation towards the financing side of all of this. I guess with oil and gas companies going into the sector, and to the extent that people discuss whether they can or cannot compete based on their cost of capital. The whole financing of renewables, well, it's not new, it's been there forever, and it's clear it's an important thing, but it has just become a very big question, right? And the growth in green bond financing and also like hybrid bonds, etc., is driving kind of financial optimization race, if you want, to get the cheapest cost of capital. So how do you see these trends, and how do you see the cost of capital impacting the success of renewable developers in the future?
Our view is that it's one of the most important components of the profitability of renewables. I mean, I think perhaps a good articulation of that is when you look at the operating margin of a renewable project versus a thermal project, the input cost is much less. So it's primarily a monetization of cash flows, as opposed to looking at the input costs that go into it. So our view is, and one of the reasons our company exists is based on how important that trend is. I think that just generally speaking, we see the interest and focus on ESG bringing a mass amount of capital into the space, and I think that we don't really see that changing. So I think that the supply of capital is very much here, and a contributing factor to some of these different yields. I think that, as you mentioned, there's many different structures. I think a lot of those structures are just finding the right pockets of capital, and so both of these trends are, I think, in our view, very much happening.
I would definitely support that view. So we do not have scarcity of capital. We have scarcity of good projects, and let's say good projects lining up really. So in order really to achieve also our CO2 targets, so that I think is hard to see how quickly we can really shift that the energy system from a still today very much conventional power plant dominated system into a more and more renewable system, also with the introduction then of storage. But I think the shortage of capital is not the thing which we will be complaining about. It's more let's say sustainable support mechanisms, like we have discussed at the very beginning. Capital is very shy, and so if support mechanisms change, that is no good for the capital, and then good projects also, and above all in Europe. I mean, onshore wind is really a difficult topic now, because you're more or less not able to build new projects given, let's say, all kind of restrictions. So therefore, that is, I think, will be the limiting factors, but not capital.
Yeah, Lisa, I think you're back. You lost your connection for a second. Do you want to finish what you were explaining?
No, I think I'd finished actually, but then the connection dropped for some reason. Sorry, I wasn't popping out for a cup of tea.
Okay, so we got one question here, Dierk, referring to a comment that you made before around green hydrogen not being in the money for the next couple of years and relying on subsidies. So I think the people want to understand a bit more, why is that, and what are the reasons that you think are stopping green hydrogen from really picking up?
Yeah, it's as simple as it hasn't reached industrial scale. So I mean, you have to scale that technology is there, so that works. So that is not the question anymore. It is now scaling it up, let's say, to industrial levels, bringing costs down, as we have done with the other technologies, and then you are there. So therefore, it's just a matter of time. I'm 100% sure. It won't be the technology. Above all, we have one important, let's say, one important success factor will be that you can use existing infrastructure. Like the gas pipelines in Europe, so at least partially, and so that is one, let's say, further pro for this technology. But overall, I would say technology costs have to come down, and then we will be there. So I'm pretty convinced that this will be technology of choice, not the only one. So that's always to be remembered. It will be it is an additional technology which we can use in future.
Yeah. And I think building on those points, I think so far we've laid out a picture where we see that companies need to get smarter, both in their cost structure, also energy management, trading capabilities, risk management, and also commercial capabilities, right? And find new pockets of value. To what extent do you guys see that hydrogen will integrate with renewables, and actually integration will be required as another offtake for power, for green power? Or will you see that actually it's not really an integrated play and you can decide to go in, opt in or not?
We see it, so at least from our perspective, we see it integrated. We have our first smaller project out now, which we are going to hopefully build within the next 2 years. Solar plant combined with hydrogen and or with a electrolyzer. So for us, it's just do it, yeah, and get experience and get costs down. So therefore, we see it from an integrated perspective because it will be needed probably in order to tap into different times of the day in order to let's say market your power. I mean, if we are all selling at 12 o'clock, we know how the curves look like. Yeah, so that is probably not the best strategy ahead of us. So therefore, you have to build in flexibility, and hydrogen will allow for that. For this, as batteries do also to a certain extent.
Yeah. But maybe Marc, you wanted to mention something?
So we're not seeing nearly as much hydrogen. I think that's primarily just because the U.S. is not as far along as Europe is on that front. However, we are seeing a good amount of integration, particularly on the behind the meter side, with multiple different technologies coming into play. At least for us currently, it's primarily batteries. But we do see that on the development side and also on the client demand side, looking for perhaps not a base load project, but something that can at least absorb some of that intermittency that comes with solar. So again, on the behind the meter side, we're seeing that deployment already happen. It is happening on the grid connected projects as well, but perhaps just not quite at the same level of deployment just yet for us.
Yeah, and then I mean the hydrogen projects we're looking at, let's face it, they're not all directly connected to renewables. They're all grid connected, and it's very important when we're trying to get the economics to work that those can run on a sort of base load basis. You need to maximize the generation of the electrolyzer. But of course, you know, if it's meant to be a green hydrogen project, you do need to have an associated renewable energy supply. Most people are doing that at the moment through sort of buying in green certificates, or they may have their own wind park or solar park. But the actual electrolyzers are being grid connected. So in terms of integration, well, they both have to coexist in the market. integrate. And the first projects, I would say, or and this is reflected in the European strategy. The first plan is to generate the hydrogen where it's needed for sort of industry, to decarbonize industry. I don't think storage is really plan one. And then going forward, it will be scaled up and then used for other uses. But I think at the moment, the industry and biofuels is where we're seeing the two biggest use cases, and maybe mobility as well.
I would, Lisa, I would share your view. The however is it very much depends on the technology now. So how the technology can be used, let's say, for decentral projects, yes or no. So we see certain trends that you could also use, let's say, smaller sizes of electrolyzers, also, let's say, which make a decentral or which you can add to in a decentral way also to smaller power plants. So then I would say it will play an important role. If we just look at the big industrial scale, for some industry, yes, you are definitely right. Then storage is not the first choice. Absolutely right.
Yeah. Maybe one additional question we're getting here from the listeners is, so Dierk, I think you mentioned before that what you considered problematic is the lack of good projects or finding good projects. Yeah. Right? So you could expect that you will get a question on that one. So basically, is there a lack of good projects? What's behind your statement?
Yes, I mean, it should always be the case. Otherwise, I would say that we take everything. So we are very selective in taking our projects, and we test them really to an extent possible. So not all I could at least say that out of 100 projects which we are offered, we will only take 2 or 3, or 4 maximum. So we are very, very selective, and therefore there's always the lack of very good projects, and very good projects means there has to be a margin for the developer as well as the one who takes the risk over the next 30 years. So I do not believe in these kind of projects where the developer gets a good margin, walks away, and then you stay with the rest and without being able to make any margin. So this is not a good project, and so therefore there's always scarcity of good projects. In this sense, I meant that.
Okay, understood. So in the sense of Encavis business case.
yeah. So it is. Yeah. So I'm CEO of Encavis.
I would say it's exactly the same on the debt side. I think for every 100 projects we see, I probably turn away 80. There's a lot of bad projects out there, and there's a lot of just running around looking for the lowest cost of capital, squeezing the debt service coverage ratios as tight as possible, refinancing, squeezing market, or putting up really long merchant tails, very depressed margins for 20-year tenors. I mean, it has to be a good deal. It has to make sense, and give upsides to parties as well for us to be interested in it.
Yeah, and maybe going back to one of the points that we got mentioned, right? So we've discussed like the feed-in tariff regime, we've discussed the merchant route, and obviously in the merchant route to market, clearly corporate PPAs are important because there's currently not much liquidity in the curve, and therefore you need them on the longer tenors, right? For the length. Now, one could argue corporate PPAs have been booming, right? For the last couple of years, you see exponential growth. At the same time, if you look at the big picture, it's still growing on a small, starting from a small point, right? So the question is, do you think the corporate PPAs will play an important role, a central role going forward? And if yes, then what needs to change, or what incentives do you need to have in place for this really to happen and have corporates driving the energy transition? in a context of low prices going down, and then also corporates thinking, okay, more renewables, lower price, more better technology, so I better wait for a couple of years, right?
I don't think that they have the luxury to wait because most corporates, at least the bigger ones, and not let's say limited to the technology firms from the West Coast, have set out themselves very ambitious ESG targets, and with most of them achieving, let's say, in their power supply, a rate of up to 100% renewables within the next end of this decade, or let's say within 10 years. So this is very, very ambitious. And I would say that most corporates who have set themselves these targets don't know how to achieve that today, from today's perspective, because they have to replace quite a lot of power. So therefore, I think that the corporate PPA market will be booming, but not at any price. So therefore, we still have to provide power at competitive prices. Then we will see that demand from the corporates. And let's not forget, it's the first time that corporates can log in power prices for more than 2-3 years. I mean, normally, if you hedge your power, you get contracts from the, let's say, trading partners of 2, 3, 4 years, sometimes 5 years, but not more. Now you can log in power prices for 10 years, 15 years, or even 20 years, like aluminium smelters, for instance, in the Nordics do, and put that as stable cost factor into their strategic planning. So this is all possible with renewables and is not possible with the conventional power market. So therefore, I think corporate PPAs will play an important role in the future.
Yeah, I think there's various different types of corporate PPAs. You've got the true corporate PPAs, which I think is what Dierk was referring to, where corporates are actually, buying green power against a fixed price. But and that's been the case in the Nordics. It's been quite a lot of the physical corporate PPA purchasing. If you look at the PPAs which have been done in Southern Europe, it's utility led, and so it's not really, we think of them as corporate PPAs, but they're not. They're utility written PPAs, which are often hedged through trading arms. So that's type 2. Type 3 is a corporate PPA, but it's not actually being used as a hedging instrument for a wind park. Probably 1 in 5 PPAs I read about on the internet, I know for a fact, it might be someone like a big utility has written a corporate PPA with a corporate, but that wind park or solar park has got a feed-in tariff against it. So that corporate PPA is not actually functioning as the hedging instrument. So that's the other nuance, and that probably distorts the corporate PPA market. And then, of course, there's the power hedging. And because of the problems with writing some of these PPAs, I mean, they need to get a lot more liquid. We need to have a more liquid market to stimulate it, of course. It needs to be easier. It's kind of a laborious process to enter into a proper corporate PPA. So quite a few projects we've spoken to, they've just gone and done, 7-year power hedges and roll those forward. And when you look at them, they're quite similar to the synthetic or financial PPAs. So, they probably think, why do I bother going through a whole negotiation process with an off-taker when I could just go and hedge for a 7-10-year tenor on a power market? So, but anyway, from a renewable generation and growth perspective, we're relatively agnostic as long as the hedging achieves its purpose, I think. But again, I mean, the corporate PPA market could grow further, let's say taking in the full spectrum of the options that I just mentioned. And of course, adding hydrogen into the equation is a really important additional off-taker.
Yeah. Marc?
We're seeing continued growth in the corporate PPA market. It is very much driven by their just general decarbonization targets as an organization as a whole. We've seen a few different flavors of corporate PPAs, but generally speaking, they're largely virtual PPAs. But at least in what we've seen, very few of them are fixed volume PPAs, and so they do present a bit more investor friendly structure than, let's say, a true bank hedge style agreement. And at the same time, they're not the utility bus bar PPAs that we've seen in the past. So I think almost every utility scale project we look at now, or portfolio that we look at now, has some amount of corporate PPAs, and we fully expect that to continue into the future.
No.
And let's not forget that there are two other sectors really kicking into the power markets. On the one hand, the mobility sector.
Mm-hmm. And now we lost Dierk. So while
we'll have to guess what the second one was.
So maybe one question to you, Lisa, that we're getting here from the viewers is, so they're asking, to what extent do you think there's an effect of governments, and there's explicit mention to the Netherlands, require 50% kind of local ownership? It's a very specific question, but I don't know if, but basically.
I saw that question.
Yeah.
I saw that question, to be honest, and I actually do not recognize it. There's no renewable project in the Netherlands I know where the government wants at least 50% renewable ownership. So I would ask the person to contact me directly or through the networking app, and then we can discuss it further. But I mean, when for the oil and gas market, there was always a minimum percentage of an entity owned by the Dutch government in those projects. It's not the case, as far as I know, for the renewables market. They've actually always been very generous on local content. When they designed their offshore wind auction, there was a whole debate about whether to impose local content or local ownership requirements, like some other jurisdictions have done, like the French. And they said no, they wanted to keep an open field, and that's why I think they're quite liberal and commercial in that front. So, but maybe I'll hear from the person who asked the question directly, and I can answer it.
Perfect.
Sorry, I'm back.
We didn't hear you. We didn't hear your second.
Yeah, I heard you, but you didn't hear me. So now the second sector. So it's the heating sector, which will also be partially led by power. So therefore, it's also on the demand side. I think we shouldn't worry too much. So there will be a lot of green power demand in the future, be it corporate PPAs from the mobile sector, heating sector, and so on. So I think there's lots of growth ahead of us, which has to be fueled with green energy.
Yeah. Great. I mean, given that we're in the Q&A part now, I think that we have one other question. I'll read it out loud. I'm not sure if this is very US specific. So Marc, I'm looking at you here. So how will corporate PPAs affect utility-based revenue, which will drive higher costs to the residential ratepayers?
I'm maybe going to infer that the question is primarily based if the utility's not actually getting the revenue, but the projects are.
Exactly.
There's less. The fixed costs are spread out around among their customers. Okay, so that is a dynamic we see. It actually comes up a bit more frequently in the U.S. DG space because there's a concept of net metering, and I think that it's also dealt with much differently depending on where in the states you are, because many utilities actually are not owning generation within the regulated arms anymore. So unfortunately, I don't think there is a great answer to the question. It is a dynamic that does come into play, particularly with net metering. And it's something.
Yeah, I was going to say, is it more of an issue with net metering and distributed generation?
Yes,
there?
And it's something that the industry is having to deal with. And I think what we've seen is the pushback on this dynamic is leading to a much greater deployment of the integrated, let's say, solar plus storage technologies, where there's less reliance on selling back to the grid, and that's been the primary way that the industry has started to address the concern, and we're seeing the deployment rate of storage increase exponentially on these behind the meter projects.
If you would take it from a helicopter view, I think utilities will get more competition for their business model. As let's say in many other sectors, the middleman has been taken out, and I wouldn't say that utilities will not be there anymore in a couple of decades, but definitely we will see different business models, and for some of which you do not need the utility in between. You need the grid, and so not the fully integrated utility anymore.
Yeah, we've also seen a bit of concern from utilities about the rise of PPAs and asking to discuss their model. But to be honest, it's a little bit more nuanced. I think if you look at the Southern Europe, it's not really the utilities are doing the PPAs, not the corporates. So they're getting the business anyway. In some cases, when there's a true corporate PPA, to be honest, normally the utilities involved anyway to sleeve the risk. And they're earning fees on the sleeving. When we've discussed this with utilities before, they tell us it's not their business model to take that price risk anyway. So they don't feel they're getting paid for price risk. They're getting paid for sourcing and distributing the electricity. So in a way, they've still got a piece of the action even with the corporate PPAs. And as I said, a lot of the first electrolyzers are all grid connected anyway. So the power is coming from utilities and not coming from, in that respect. So, but certainly there is a bit of concern, I think, about other people stepping on their territory.
Yeah, maybe one other question that we've got on the chat to continue the conversation. We've talked about PPAs becoming shorter term, shorter duration, and obviously that affects the way you finance the project. So maybe Lisa, this is one for you. People are asking how would you debt finance in the context where you have basically a shorter term PPA and not like a 15-year PPA, more like a 5-year PPA.
Yeah, I don't want to give away all my structuring secrets, but basically, yeah, I mean, this is quite common where you have a PPA typically for around 10 years, and then that is insufficient to get full amortization on your debt or to deliver the required equity IRR. So we tend to put an extra period on the debt, which is indeed a sort of merchant tail, we call it, with merchant revenues. And we need to build in certain protections because even during that first 10-year period, the hedge is not for 100% of the revenues. So you're already taking merchant risk, and then you'll be taking full exposure if there's no hedge refreshed after that first PPA term expires. So we work with things like contingent sweeps in the structure and refreshing the power price. When we look at the forward-looking DSCRs, that means that if you're asked to take merchant risk for a period of 15 years, you need to make sure that you kind of do a mark to market of that risk, and you have various ways to trap cash within the project to protect yourself from that merchant risk.
I would say if I look at our projects, the two ones which we have done in Spain, just the leverage has just come down. So I mean, with a feed-in tariff park, you could lever, which we never did, but you could lever up to 100%, or some even did more than 100%. So that's definitely not doable with the PPA. So the one with the deal with Amazon we did in Spain was on a basis, that project was done on a basis 50-50, something like that. So 10-year PPA allows for a kind of 50-50 structure, 50% equity, 50% debt, sometimes a little bit more, but that's probably the structures we are looking at, and not anymore the 70-80% leverage, which we have seen before. So it needs just more equity.
Yeah, which is a mitigant in itself, extra skin in the game from, indeed. I mean, you're right, Dierk. In the Netherlands, where the tariffs are quite high, we see some projects leveraging up to 95% just because they can. But of course, that's not comfortable from a debt perspective, even if you've got a long tariff underneath it. There's no what we call skin in the game. So that greater equity.
And it's not also, what I would say, it's not something you should do as a prudent investor. Because I mean, you take a lot of risk, and at the end of the day, I mean, we all expect, let's say, a certain power price curves, but we do not know. And so therefore you have to protect yourself in other ways. And one is so that you take a certain limit on your leverage and pay back the debt as soon as possible. And then you stay with a, let's say, 100% equity financed park. And if you are then hit by lower power curves, then at least you can sustain it because you have cash costs against it. And that then you should be fine. But if you have, let's say, then still the that full amortization of the capital ahead of you, then it can hit you. So therefore, that is also prudent.
Maybe Marc, one last comment, and I think we're almost at the end of the session.
Sure. So we generally invest in equity or equity-like products. So things like preferred equities. We're not quite doing senior debt that Lisa, you might focus on. But we look at it in a very similar way, where we probably don't have the same amount of protections that you do, just given our equity position, but we do have sweeps and protections to account for some of the volatility in long-term power pricing. For us, we see some markets in the US that can't support any debt on projects, just given the dynamics of the contract structure, and some where folks are levering up as much as possible. So it differs quite a bit.